then I'll immediately start the class. Yeah. So today's topic is leasing. Okay.
Yes, sir.
So what is this leasing all about? Any idea regarding leases? See, what
We give
happens, like, yeah, please tell me.
yeah, we give part of land for rent or building for rent.
Yeah, so let's start with leasing. See, leasing is nothing but suppose there is a suppose you want to start a business activity. To start a business activity, you require a premise. This premise, either you can purchase to buy this premise, or to purchase this premise, you have to apply for a loan. Okay, and many like if you are eligible for the loan, that means if bank is ready to give you loan for purchasing this premise, then that's well and good, that's all right. But if you want to buy this particular premise, it will be a commercial property. Commercial properties are like in general very costly, okay, unlike the residential properties, because commercial properties have to be on a prime area, and since it has a lot of value, because you can generate very like economic benefits on a higher scale. So there is a lot of demand for commercial properties, because like commercial property would be in a prime area, would be in a prime location, because you need to attract customers. So definitely the cost will be very very high for this. And for a very costly property, if you apply for a loan, you need to do a down payment of some 20%. Are you understanding what I'm saying?
Yes, sir.
And the rate of interest would also be very high for this. So high rate of interest, point number one. Costly property, very costly in the sense, if you want to buy a like 2 bhk 3 bhk flat, it would be for 1 crore in some area, but commercial property would be way costly. Okay,
Yeah.
loans are not easily available on commercial properties, unlike the residential properties. For residential properties you can easily get a loan, but for commercial properties, seeing the risk involved, okay, because it's a very costly one na, and for a long time they have to give a loan to you, and you should also be eligible as per the banks to get a loan. If you're not eligible, then again you cannot buy the property. Okay, so loans are not easily available always for a commercial property, because here you have to apply for a loan. In residential properties, the builders will have a tie up with the bank, and they can easily like help you in processing for the loan, correct?
Yes, sir.
Loans are not easily available always for a commercial property, when compared to residential property. You have to first make yourself comfortable with the subject, okay, because we only hear the terminology, but we don't know in reality what is happening. Eligibility criteria will not be met always. That means you will not meet the, if you don't meet the eligibility criteria, for getting a loan, then it would be tough for you to get the loan, correct?
Yes.
Eligibility criteria will not be met always. If not met, you may not get loan. And even though if you get a loan, interest would be high rate of interest. As I said, you can also claim deduction on the interest what you're paying. But either way around, if you take a property on lease, the lease rental also happens to be an expense for you. You can claim deduction in that case also, correct?
Yeah.
So both the cases you can claim deduction. Am I right?
Yes, sir.
So I am just discussing some points regarding buying versus leasing. Why people go for lease? Why not always they buy? So for buying, these are the things you need to take care of. You have to bear this high rate of interest. Property would be costly. Loans are not easily available always for a commercial property when compared to residential property. You may not be eligible at times to get a loan. Okay, and deduction can be claimed for interest as well. We can claim for lease expense. And also you have a lot of pressure to repay back the loan if your business doesn't work out. If your business is in losses, then you always have a pressure to repay that loan. Okay, so
Yes.
obligation. See, in lease also there is an obligation. I'm not saying, but obligation, you have a obligation here, but that would kind of create a pressure on you if your business is not doing well. Okay, because you put a good amount of money here as a down payment, correct? You put
Yeah.
20% of your money as a down payment, which you would have utilized for purchasing stock or buying some other non-current asset for your business purpose, correct? Instead of that, you
Yes.
have to put it here. Am I right?
Yes, sir.
But in case of leasing, you need not pay that, and you can utilize that good amount of money for your business purpose.
Yeah.
Obligation in pressure times, very tough. Just a minute, okay?
Yes, sir.
Yeah. So you understood now. See, what are the challenges with buying a property? With leasing a property, what is happening is there is no pressure of down payment. Point number two is lease rental can be claimed as a deduction like the interest. And see what happens is in previous times, like when, see, this particular leasing is dealt with two standards. One is IAS 17, that is leases, and one is like a new standard recently introduced, IFRS 16. So there were some issues with this, which have been rectified in this. Okay, this used to consider lease in two ways: operating lease and finance lease. Correct? Now there
Yes.
is no such terminology like operating lease or finance lease. Now lease is just a lease, okay? But some kind of differentiation has been done. Some kind of refinement has been done in this. We will read and we will discuss that in the coming slides, okay?
Okay, sir.
Yeah. So like down payment, there's no requirement. Rather, you can utilize that down payment for your for better like you can use that money for your other non-current assets which would be very useful for your business, and lease rental can be claimed as deduction. And here generally what was the difference between operating lease and finance leases? Here you just use the asset, and you just pay the lease rental to the lesser. Okay, first of all, let's understand what is a lease agreement. Lease agreement is nothing but it's a contract between two parties. One party is the lessor and one party is the lessee, and this party they make a contract between them. That contract is nothing but lease agreement. Okay, as per which lessor would collect the lease rentals from lessee, and lessee would get the right of use of the property from the lessor. Okay, the property is not of lessee, but he gets the right of use of that
Use.
asset. Got my point?
Yes, sir.
That means he has the right to use the asset, but he cannot claim the ownership from that asset, except in operating lease it cannot happen. Why it cannot happen in operating lease? Operating lease is suppose there's one vehicle which the lessee wants to take on lease from the lessor. He takes that vehicle from the lessor, he uses the vehicle, pays the lease rental, whatever the expenses there to the lessor, and gives back the asset back to the lessor, or returns back the vehicle to lessor. Okay, so in this case, that is a classic example of operating lease. And here, who is going to take care of any risk related or associated with that property? Who is going to take care of that?
Yes, sir.
Who is going to take care of that?
Yes, sir.
Lessor. Just a second, Abhinav, just a second. So lesser in case of operating lease, who takes care of the asset, and the risk who bears the risk related to that asset? The
Lessor.
risk and reward is not transferred to lessee. It is with whom? Who retains the who retains the reward, and who takes care of who takes care of the property, or who is what we say, who would be the one who would be in charge of that property?
Lessor.
Lesser. Any damage happens to the property, who will be responsible?
Lessor.
Lesser. Lessee has nothing to do with the any kind of risk associated with the property. But in case of finance lease, this lease can be a short term or more than 1 year also. Okay, operating lease. Finance lease is the one which is for a long term. And this lease is something whereby the lease can be for 10 years, 20 years, or 30 years, for a long term. And the risk and reward associated with the asset is transferred to whom?
Lessee.
Who will take care of everything related to the property? Any damage happens to property, who will be responsible for that?
Lessee.
Because he is going to take the maximum benefits out of the asset, and he is going to use that asset for a longer period of time. He has to take care of the damages, whatever happens to the property, he will be responsible. Okay, unlike in the operating lease. So you clearly got the difference between operating lease and financing lease.
Yes, sir.
And in finance lease, one special feature also they have. The feature is nothing but the lessee has a right to own the asset after the at the end of the lease agreement. That means lessee would be buying the property from the lessor. Okay.
Yeah.
Yeah, so what happens in this is, I'll give you a good practical example. See, this is a lessee. Suppose this is SpiceJet Airlines. or you can say to some extent this is like Indigo. They want to buy, like suppose SpiceJet or Indigo wants to buy 30 flights from Boeing company. So do you think they can pay a complete payment of those flights to Boeing company?
No.
They would take the proper, they would take the flights on finance lease. That means Boeing is the manufacturer, okay, or Boeing will see, Boeing is the manufacturer of those of those flights. Who is the manufacturer?
Going.
So Boeing would manufacture the asset for SpiceJet or Indigo, or if Boeing is not there, there's some lessers, like we can say some big insurance company or some banks. What they can do is they can buy these flights for whom? SpiceJet and Indigo. Got it?
Yes, sir.
They can buy these flights from Boeing, okay, for SpiceJet and Indigo, and they can give those flights to SpiceJet and Indigo on lease or finance lease, okay, for which they would be getting a fixed rental on monthly basis. Got my point?
Yes, sir.
And at the end of the lifetime of the lease, when the lease agreement comes to an end, SpiceJet and Indigo would be owning that asset, okay.
Yeah.
So these guys, why are they doing this? These guys cannot buy those flights outright. Generally, Boeing will buy the flights for them, and Boeing can also give the flights to them on lease. Or insurance companies or banks can buy the flight from Boeing, and they can give these flights to SpiceJet or Indigo on lease, and they can collect lease rental for some 30 years or something, and SpiceJet and Indigo can earn their returns from that, repay the lease, and at the end of the lease term they can own the asset. So in this case, in this way the lease agreement goes. Okay, what is the
Yes.
difference between rent and lease? Rent has to be paid every month, and if after 1 month if you don't pay the next month's rent, the rental agreement gets cancelled. In case of lease, there's no problem, it can continue for a longer period of time. Okay, generally this is for longer period of time, this is for a shorter period of time. Okay,
Yes, sir.
here also if you don't pay the lease rental, then there's a issue, but you can manage with the lesser. You can have a discussion with the lesser, and delays and all would happen. See, in general, like laws are different, and in practicality things are different. Okay,
So there is no particular time, sir, for the payment of lease.
for
For the payment of lease.
see, there is a every month you have to pay lease rental, monthly, yearly, whatever the you have discussed with the lesser. Based upon that, you have to make the payments.
Okay, it might change. So, okay.
Yeah, it is upon the agreement. Okay.
Yeah.
So now let's go into the topic. Now I hope you have easily understood what is happening here. Correct?
Yes, sir.
Now IFRS 16 was brought in to remedy the non-recognition of liabilities for assets held under operating leases. So previously what used to happen is, in case of operating leases, the firms, the lessees who used to take the properties on operating lease, they were not recognizing operating leases liabilities in the balance sheet. That was considered as a off balance sheet item. But because of that, what was happening, they were taking the lease for longer period of time and showing us a operating lease without showing any liability in their books, just showing lease expense in their P&L account. But what has happened is IFRS, so with that what used to happen, these guys used to show their balance sheet in such a way that they did not have any kind of liability, but they had big liabilities. Correct?
Yeah.
That was a kind of manipulation was going on, but that manipulation has now come to an end with IFRS 16. Why? Because now IFRS 16 does not differentiate between operating lease and finance lease, and every lease, whatever kind of lease it is, have to be shown as a, like if you take any property on lease, whether it's an operating lease or a finance lease, you have to show the asset in the balance sheet, asset side as a right to use asset, and you should show your lease liability obligation in the liability side of balance sheet. Okay, except in some cases, and those cases are nothing but for very like as for assets which are for a very short span of time you're using. Okay, or very low value assets. What I'm saying,
Low value or short time assets.
short span of time you're using the assets for. Okay, low value assets are nothing but laptop, computer, you'll be using them for 2 to 3 months. Those will not be like considered as a obligation and will not be shown in the liability side of balance sheet. So every lease, whatever lease it is, have to be the asset should be shown as right to use asset, and the liability should be shown in the liability side of balance sheet, except for low value assets and for a asset which you are using for a short span of time. Okay.
Yes, sir.
So it replaces IAS 17, which required lessees and lessors to classify their leases either as finance lease or operating lease. So this was according to IAS 17, they used to do that and account these two types of lease differently. But do you think it is happening now? No, it does not require leases to recognize assets and liabilities arising from operating leases. What was not allowing that to happen? IAS 17. Okay, but with IFRS 16, this has come to an end. This treatment is not no. This treatment holds no validity right now. Got my point?
Yes, sir.
Now, as per IFRS 16, every lease has to be shown in the asset side. Every asset which you are taking under as a lease, either operating or financing, they are not differentiating between leases. You have to show, recognize the assets in the asset side of balance sheet as right to use asset, and liability or obligation towards that asset in the liability side of balance sheet. The obligation you have towards that asset towards lesser. Okay, you are supposed to make the payments to lesser, now that liability you should
Yes.
show in the liability side of balance sheet. Now, IFRS 16 introduces a single lessee accounting model and requires a lessee to recognize assets and liabilities for all leases with a term of more than 12 months. How much?
More than 12 months.
12 months. Unless the underlying asset is of low value. Did I say that same thing?
Yes,
So
sir.
now any asset which you're using for more than a year, okay, whether it's a finance lease or operating lease. See, finance lease, I already told you what is the terms and condition of finance lease. In case of finance lease, the risk and rewards related to asset are transferred to lessee. In operating lease, the risk and reward is retained by lessor. In finance lease, see who has the who has to bear, who has to take care of the asset in the case of finance lease? Lessee, correct?
Yeah.
Why lessee has to take care of the asset in the finance lease? Because risk and reward are transferred to lessee. In case of operating lease, who has to take care of the asset? Any damage happens to asset, who is responsible? Lessor, because he retains the asset. Okay, got my point?
Yeah.
He
Yes,
has
sir.
not transferred the risk and reward to the lessee. Fine. And
Yes.
any lease, whether operating or finance, or any lease beyond 12 months have to be accounted in the assets and liability side. Okay, except for low value assets. So short term leases or low value assets, the lease payments, that is lease expense, are directly charged to P&L as an expense. For all other leases, the lessee recognizes a right of use asset representing its right to use the underlying asset, and lease liability representing its obligation to make lease payments. So, right of use assets, this is the balance sheet, right of use asset shown in the asset side of balance sheet, and lease liability shown in the liability side of balance sheet. Let's
Okay,
move
sir.
forward. So recognition exemptions, short-term leases and low value leases. Okay. You should not show in the assets or liability side of balance sheet. You should show them as a lease expense in the P&L. So there is identifying a lease. So how will you identify a lease? So first of all, there should be a contract between lessor and lessee. Okay. And the
Yeah.
risk and reward should be transferred to lessee in case of finance lease. In case of operating lease, risk and reward are not transferred to lessee. Who takes care of the asset in case of operating lease? The lessor. Who
Lesser.
takes care of the asset in the case of finance lease? Lessee. Okay. Now next, let's read some points here. A contract is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Of course, lessee has to pay rental to the lessor. The contract may contain other elements which are not leases, such as service contract. These other components must be separated out from the lease and separately accounted for. Of course, if there is any service contract related to that property or something, would not come under lease. Separately, they should be accounted for allocating the consideration on the basis of standalone prices of lease and non-lease components. Yeah, so lease components, the prices related to this lease should be separated from non-lease components, whereby the expenditure whatever you're incurring should be accounted differently, like differently from the lease related expenses. Okay, now
Yes.
got it.
Yes, sir.
The right to control the use of an identified asset depends on the lessee having the right to obtain substantially all the economic benefits from use of identified asset. Yes, lessee would be taking the asset and he will be enjoying all the economic benefits. The right to direct the use of the identified asset, this arises either the customer has the right to direct how and for what purpose the asset is used during the whole life of, that means he will decide what to be done with that asset. Okay, who? The lessee. The
Yes,
relevant
sir.
decisions about use are predetermined and the customer can operate the asset without supplier having right to change these operating instructions. That means supplier is not going to give you any kind of instructions. You yourself have discussed everything related to the asset and you will be using it for your own use as per your own wish and will. Okay.
Okay.
The lessee does not control the use of an identified asset if the lessor can substitute the underlying asset for another. See, the asset which is a identified asset as per the agreement, that asset only you are entitled to, on that asset only lessee has the control, or he can he has to take care of that asset. Okay. Other than that, if any other asset the lessor is substituting, which is not an identified asset in the contract, then what? Does lessee has the control over the asset?
No, sir.
No, even though that gives economic benefit to lessee. So any substituted asset is not applicable. Okay,
Yes, sir.
excuse me, Abhinay. Just give a reading to this.
Yeah.
So now as you can see, lease, a contract or part of a contract that conveys the right to use an asset. Who gets the right to use an asset? Lessee. From whom? Lessor.
Yes.
for period of time in exchange for consideration, for which the lessee will pay the lease rental or lease expense to the lessor. Okay.
Yes, sir.
Underlying asset is the asset which is on which the lease agreement is happening. Right of use asset. So an asset that represents a lessee's right to use an underlying asset for lease term. Lease payments would be done, of course, by the lessee to the lessor during the lease term, and comprising of what? Fixed payments. Yes, lease would always be a fixed payment. Like when you take a loan, you pay EMIs to bank. Those are always fixed. Am I right? In the same way, this is also the same thing. Less any lease incentives. We will discuss about this incentive while doing a question. Lease incentive you have to deduct. Then
Yes.
variable lease payments that depend on the index or rate. That what is that rate? We will discuss that. Okay, that is called implicit rate or the incremental borrowing rate. Whatever it is, I will discuss. The exercise price of a purchase option, that is at the end you will be having an option to buy that. Okay, and the lessee has to buy that under the finance lease. Okay, or long term lease. Payment of the lease termination penalties if applicable. Like if you terminate the lease in between, there will be a penalty. Got it? You have to pay some
Yes.
penalty and you can terminate that. Are you following, Abhinav?
Yes, sir. Yes, sir.
Interest rate implicit in the lease, the discount rate that at the inception of lease causes the aggregate present value of. See, you would be making some lease rentals in the future, no?
Yeah.
You would be making lease payments in the future, correct?
Yes, sir.
Those lease payments you would be paying for 30 years maybe. So you need to know the present value of that liability of the future as on today. You want to know the
Present value
of those future
future.
liability, that means
Yeah.
of those lease payments which you are making in the future, you want to know the present value of that as on today. So for that you need a discount factor. Am I right?
Yes.
Hello.
Yes, sir.
For example, you have deposited 1 lakh in bank. Bank is giving you 10% interest. At the end of the year, you have 1 lakh 10,000. This is called the future value. This is called the present value. From present, if you want to go to future, you have to add interest. From future, if you want to come to present, you have to remove the interest, correct?
Yes, sir.
This is for 1 year. But if it is for 5 years, then the calculation becomes somewhat tricky. So for that, you have to come out, you have to know the concept of TVM, time value of money, because in lease and financial instruments chapter, TVM concept is a very important concept. I am explaining that concept here. Please try
Okay,
to
sir.
understand. TVM is nothing but time value of money. The time value of money changes with the passage of time. Okay. So suppose your mom gave you 1 lakh rupees and asked you to deposit in a bank, and like on Jan 1st, December 31st is what is the end of the year, and 10% is the rate of interest which bank is giving to you. What is the amount at the end of the year you would be having? 1
One
lakh
lakh.
10,000. This is what is now the present scenario. And your mom asks, like today, how much richer we will become after 1 year. So you will say we will become richer by 10,000, correct?
Yeah.
So this is in the case of simple interest, but if it is compound interest, the things would differ. The things would differ. What is the difference between simple interest and compound interest? In simple interest, you will be earning only interest on principal. In compound interest, you will be earning interest on interest also, apart from principal, correct?
Yeah.
This is 1 lakh. This is 1 lakh. At the rate of 10%, at the rate of 10%, first year 10,000 will be earning, first year 10,000 will be earning, but second year what happens? Here you'll be earning again 10,000, here you'll be earning what? 11,000, 10,000 on this and 1,000 on this, correct? So it will become 1
Yes,
lakh
sir.
21,000. This will become 1 lakh 20,000, isn't it so?
Yes, sir.
So why I'm discussing all these facts are, I'll show you. So now this is called the present value, this is called the future value. Okay. So present value plus interest gives you future value, and future value minus interest gives you present value. This is for 1 year. But if I tell you, or if your mother asks that, Abhigna, you have deposited 1 lakh in the bank at the rate of 10% compounded, after 5 years, how much amount we are going to have, or we are going to become richer by how much? So for that, this simple calculation is not applicable. We have to use formula. Formula would be future value is equal to present value into 1 plus r whole power n, whereby present value will be 1 lakh, rate of interest is this 1 plus 0.10 whole power 5. So this you are multiplying and this is called compounding. What is this?
Founding.
Why I am explaining this? Because when you come to the question of lease accounting, you will be coming across these calculations. See, present discounting and all this. Okay, so I need to make things clear to you. And I think in the first chapter conceptual framework I have given some details about this also, if you remember.
Yeah, just the theory
During
section.
impairment also I think I have given.
Yeah.
So this is the, so calculate this one fast and tell me what is the answer, Abhigna, and then present value is equal to future value by 1 plus r whole power n. This is called discounting because you are dividing here. Discounting is nothing but your future value has all the returns included in it. So those returns as on today we are not earning. Am I right? So whatever we have
Yes.
earned in the future we have to remove to get the present value. Isn't it so?
Yes, sir.
See, here what happened? You are earning something and you're getting this. But in the present, your value is this. How you got the present value? Whatever you have earned, you have removed. Correct or wrong?
Yeah.
So if I remove 10,000 from 1 lakh, 10,000, I'll get 1 lakh. Isn't it so?
Yes, sir.
So to remove, to get the present value, whatever you have earned, you should remove. To get the future value, you will multiply the returns or add the returns. You'll get the future value. Correct?
Yes, sir.
Future value includes the returns. Present value is obtained after removing whatever the returns you are like you expect in the value, the future value. Okay.
Yeah.
So now, if I take this in a simple way, 1 lakh into 1.10, that is 1 plus 0.10 is 1.10 whole power 1 will give you 1 lakh 10,000. First year's future value. Now I should get the first year's present value. So I'll take 1 lakh 10,000 future value by 1 plus 0.10 whole power 1. I'll get 1 lakh after discounting. Okay. Just understand this. If you have any doubts, you can ask me. Tomorrow also you are available for the class, Abhigna?
No, sir. Tomorrow only we are leaving Tirupati.
Tomorrow is Friday, no?
Yeah, Friday only, sir. Friday evening
I
train.
just want a 1 hour session because why I'm saying is today introduction we did now. So tomorrow, because till here I have to explain you till here only. Sale and leaseback, I have a full-fledged video that I can give you. I have the sale and leaseback video. So I need to explain you only 2 pages, next 2 pages. If we do tomorrow, your chapter would be done. 1 hour you
Tomorrow
have to
I
take.
don't think it's
40 minutes you need to
possible.
take. That's it. Okay, after the class I'll discuss. No problem.
Yeah.
Abhigna, are you getting this point? Are you following this?
Yes, sir. I understood.
Shall I move forward then? If you have
Yes,
understood
sir.
this point,
Yes, sir. Yes, sir.
are you sure?
Yeah, got it, sir.
Okay. So the one with which you are going to discount is nothing but the discount rate, or that is nothing but the implicit rate. Okay, if implicit rate is not given to you, you have to take incremental borrowing rate. That is nothing but if you would have borrowed that asset, what interest you would have paid. Okay.
Okay.
See, implicit rate would be given to you in the question. The rate implicit in the lease. See, anyone who is giving the property on lease, any lessor who is going to give the property on lease, would definitely want to make some return out of it, correct? Based upon
Yeah.
the risk characteristics what he has because he is giving the property on lease. So that implicit rate is one which is nothing but his required rate of return from that lease agreement. What the returns he want to earn from that lease agreement, okay, from this leasing the asset. So every month he wants some return with the, see, when you make a loan payment, EMI is what you will be paying. This will be having interest and principal element, correct?
Yeah.
In the same way, the the lesser also wants to earn some interest on outstanding amount. Okay, why outstanding amount? When you will be taking a property on lease, you are not going to make any lump sum payment. Suppose the lease is for, suppose you are taking a lease, you are taking a property on lease for 6 lakhs for this entire year. Divide by 12 is how much monthly? 50,000, correct?
Yeah.
So rest of the 5 lakh 50 is outstanding. Now on that the lessee wants interest. Lesser, sorry. Who wants the interest?
Lesser.
Lesser. So he would be charging interest to you on this, correct?
Yeah.
You will be making a fixed payment of 50,000. No doubt about that. That 50,000 includes interest and also
Principal.
the principal content, like that you can assume. Okay.
Okay, sir.
So while doing the lease accounting, you'll easily understand. So lease payments, the discount rate that at the inception of lease causes aggregate present value of the lease payments and unguaranteed residual value. We don't know what's going to be the scrap value of that asset at the end of the year, to be equal to the sum of fair value of the underlying asset and any initial direct cost. So what are they saying? Interest rate implicit in lease, the discount rate that at the inception of lease causes aggregate present value, total present value of lease payment plus the residual value, and that should be equal to what? Fair value of the asset plus any initial direct cost. Correct or wrong?
Yes, sir.
See, this particular lease payments, what you are going to collect from your lessee, being a lessor, or lessee is going to pay to lessor in the future, that today plus the scrap value, we don't know what's going to be in the future. That scrap value of the future's present value today. This present value should be equal to what? The fair value of the asset and if any direct cost we are putting on that asset. These two should be equal as on today, correct?
Yes, sir.
That asset's present value today should be equal to the market value of the asset today. Am I right?
Yeah. Yeah.
See, if you are buying some chocolate today for 10 rupees, this is the present value of that chocolate and also the market value of that chocolate.
Yes.
Correct, na?
Yes, sir.
Yeah. Then borrowing rate, as I said, if at all implicit rate is not given, then borrowing rate. That means if you would have borrowed borrowed funds to buy that property, what interest rate you would have paid. Unguaranteed residual value, there is no guarantee for what is going to be the residual or scrap value of that asset at the end of the lease term. Variable lease payments, of course, the lease payments, the portion of payments made by lessee to lessor for the right of use an underlying asset during the lease term that varies because of changes in facts or circumstances occurring after commencement date other than passage of time. See, the lease payments are always fixed, but it can vary based upon certain circumstances. Maybe the rate of interest has increased, maybe, or lesser wants to levy a higher interest rate or anything. That depends. That depends. Okay, that much detail is not given to you in your syllabus. Lease term is the term for which you have taken the lease, maybe 10 months, maybe 12 months or 1 year or like 10 years, 30 years, 20 years, anything. Short term lease, less than 12 months. Lease incentives, yes. If you are taking some property on lease from lessor wants to give you some benefit, some exemption, he, like, see, when you go to a shop and you buy some product from shop, the shopkeeper wants to give you some benefit, now some discount and something like that,
Yeah.
correct? Like
Yes.
that, this is a business for lessor and he also wants to give you some benefit that we will discuss while doing the lease accounting. That will
Okay, sir.
reduce your cost. Okay, so I think enough for today or we shall continue.
Up to you, sir.
No, 12:30 I have one more class, that's the reason.
Yeah, okay, sir. No problem. We'll continue later then.
Yeah, see, I want just one session, that's it. That one session is nothing but one page, two page, three page, 4 pages. 4 pages I want to continue. Just give me 40 minutes of time or 1 hour, anytime you say I'm ready, because this I have a video.
Yes, sir.
I'm calling
I'll
you,
let
Abhi.
you know.
I'm calling you.